My investing account is down about $31,600 in the last year. So I'd really like to talk about the lessons I've learned with options and investing. This is going to be more of a uncut video, more kind of just straightforward to me talking rather than having points and a lot of edits into it. So let's jump right into it. Why am I down $31,600? Well, long story short is I got into options. I learned about options and I got really overzealous with options. What I ended up doing was I started doing a lot of covered calls and cash secured puts when the market was in a bull run, right? And when everything's in a bull run, it's easy to make a lot of money. But here's the thing, bull runs end and the market's correct after a while. So ultimately, I ended up losing money, right? Cash secured puts and covered calls are a great way to make money. I was making anywhere between $1,000 and $3,000 per month doing that. And I was racking up a lot of money in my Robinhood account. And then I started to dive into what's called LEAPs, LEAPS, which is long-term equity anticipations, LEAP for short, right? And what it is you're buying a call that is very, very deep in the money with over a year out in expiration, right? So when the stock moves up, that option moves exponentially up with it. You're almost making $2 for every $1 the stock moves. But here's the problem. When you buy these leaps and the stock actually moves downwards, you're losing just as much money as you would be gaining. And one of the biggest lessons I've learned is when you're getting into options, right? Don't over leverage your portfolio into options. What do I mean by over leveraging your portfolio? Don't put more than 10 or 15% of your entire portfolio into options. Well, here's the problem that I did is I was like, oh my God, leaps are an amazing way to make money, right? You buy a leap, which is like owning 100 shares of a company without actually doing it. So it's cheaper to do it. And then when the stock goes up $5, you're making 5 times that. So you're just making tons of money. Well, that's great in a bull run, but what happens when we've had a market correction like we've had, the last couple months where a lot of the tech stocks have really slowed down or dropped a lot in price? Well, I over leveraged in those tech stocks. As you can see, I got an NNDM, Leap Call, Jumia, Neo, and Palantir. Well, all of those have done completely terrible in the last couple months, and I am down a lot of money because I over leveraged in those positions. I have multiple calls, and over 50% of my portfolio has been in these leaps. Well, that ultimately hurts. So that's kind of why I'm down $31,600 to date, not including all the other stocks that I own are kind of just down in general because I over leveraged myself into the tech sector. I went very big and heavy into the tech sector because tech was booming, but then we had the tech correction and tech's not doing so hot right now, which is why I'm down a lot of money. Second thing I learned is options are a fantastic way to generate money and really to amplify your returns, but they should not be the end all be all in your portfolio if you really want to have steady growth over the long run. Right? And don't get me wrong, I'm just learning options, and I don't think anyone ever knows 100% everything and they're the perfect options trader. But there are definitely a lot of people out there that know way more than I do. I try to stick to the simple things, covered calls, cash secured puts, and leaps. I think those are some of the most basic option strategies. I definitely do not do anything with the wheel. I don't do anything with spreads or anything of the matter like that. I mean, I do a little bit of the wheel because of my cash secured puts and covered calls, but I definitely don't do anything with spreads. I don't buy short calls or short puts because those are very risky and the percentage to success on those is very low. But there's a lot to learn with options and I'm still learning. And as you can tell, I have lost a lot of money in my process of learning. If you're gonna learn through options, definitely start with a small amount of money, because you're gonna have to lose some money to actually learn. I learned don't over leverage into leaps. I learned when selling covered calls or cash secured puts, I've learned how to roll them down and out or how to close them out when I have a certain percentage of a gain. There's a lot of tips and tricks that you can learn for options to become more successful in them. Another thing that I learned is when you have a cash stack. So what I'm saying is when you have a good amount of money to invest, typically lump sum investing beats dollar cost averaging, right? If you have $10, $15, $20,000 sitting on the sidelines, it's better for you to invest that into an index fund like an S&P 500 ETF than to dollar cost average that amount throughout the next year or two or whatever the time frame may be. But here's the kicker, right? If you have a lump sum of money, like I ended up having about $10,000 from doing my cash secured puts and my covered calls, right? Well, what I ended up doing was just investing that $10,000 into leaps, and I over leveraged myself, and I was like, oh my God, I'm just gonna gain a ton of money that way. But ultimately, that was a terrible idea, because if I would have just held on to some of that, so if I would have invested, let's just say 25% of that, and I would have kept the other 75% just sitting as my cash balance, just waiting to invest, when the market did correct, when I invested in those leaps, and they dropped by a significant amount of money, I could have then just bought more leaps with that money. So when they started to move back up, I would have recouped some of those gains. Or I could have just invested into the actual stocks themselves or some other growth stocks to really secure that money, rather than just throwing it all into one type of option and thinking I'm gonna hit it big and make a lot of money because we're in a bull market. And ultimately I didn't. What I'm saying is dollar cost averaging is great when you're putting it into your 401k or your Roth IRA and you're getting paid paycheck to paycheck. And lump sum investing can be fantastic if you get a big bonus or some sort of like inheritance, if you put it into a safer investment. Don't throw that into options. So lesson learned, don't throw a big lump sum of money into options trying to hit it big, even if it is a leap in a more solid company like Microsoft or something. You might be better off just buying 100 shares of that, because then there's no expiration date. So if Microsoft tanks, you can just hold on to those shares until ultimately it recovers, because it's such a large company. Another thing I learned is don't invest into speculative companies that have major price swings. And that should be a no-brainer, Ace. Obviously, well, that's what I did, because some of these speculative companies were really popping off at the time. I FOMO'd in, which is fear of missing out. I invested into these companies and bought some leaps into these companies because I thought, you know what, they're going up, I'm going to ride the wave. Well, I rode the wave up, and I definitely had chances to sell at a very large profit, but I didn't take those chances to sell, and I ended up riding that wave back down and crashing and burning to my negative $31,000 today. Overall, my retirement portfolio accounts are still doing fine, because all of those are invested into your ETFs, your S&P 500 index funds, your total stock market index funds. So those are growing and those are doing fine. So my retirement portion hasn't been affected. But this Robinhood account, which I consider my play with account, my play with money, that I'm trying to really leverage and grow as much and as fast as possible to accelerate my retirement accounts, or to be able to buy another rental property or whatever I want to use that money for, has really tanked and burned over the last couple months because of what I've done to it. But the benefit when you're investing in the leaps, they have a longer out expiration date, right? So these leaps don't expire until December or January of the upcoming year, right? So I have time for these stocks to recover in price and make some of that money back. Yes, I'm down $31,000, but there is a good chance, if the market continues to come back up and more money starts to come into those tech stocks and those speculative plays, that these stocks will recover in price. Therefore, my leaps will recover in price, so the option price will go up and I will get more money back, and then I won't have to sell for as much of a loss. So maybe that $31,000 loss could be cut into a $15,000 loss, and then I'm not so far down. But looking on the bright side, at least I'll be able to write off those losses. So this last year I paid $3,000 into the IRS. I won't have to pay as much into the IRS because, I'm going to lose so much money in my play with account. Another thing with investing is it's not technically a loss if you don't sell. So as long as you're holding on to it, it's just imaginary money that's out there floating around. And as long as I don't sell, I don't incur that loss. Now with options, there is an expiration date. So ultimately, I'm either gonna have to sell to recoup some of my money, or I let it expire worthless and I lose all my money. So there's a date with some of those leaps and some of these options where I have to ultimately exercise them or sell them at a loss so I recoup some of that money, which is the great thing when you're just owning stocks. If you don't sell, it's not a loss. You could hold on to a stock that's tanked 50, 80% of its value for as long as you want. As long as it doesn't hit zero, there's still something there, and there's a chance that it'll recover depending on the company. This was just a really basic video of me being candid with you. I'm down a lot of money, why I'm down a lot of money, some of the lessons I've learned about investing. Ultimately, if you're investing for your retirement, stick to good, solid growth strategies with your index funds. That's some of the safest ways to do it. And if you're getting into options and you're just learning, make sure you do a lot of research and start with a small amount of money. so you don't lose as much as I have over the last year. And remember, bull markets always end. There's always going to be a bear market following a bull market. We're going to have corrections. I'm an eternal bull. I ultimately think the market's going to keep going up for the next 100,000 years, whatever it may be. And these stocks will ultimately recover, but the fact that I put them into options means I'm probably going to lose a decent amount of money. That's okay. I'm confident I'll make it back over the long term. I'm just going to have to reallocate what I'm doing, do a little bit smarter and safer things in the future, and I'll keep you guys updated on what I'm doing with that going forward. But as of right now, I'm just sitting on this, and I'm just going to let it ride until at least September timeframe, and then it's getting to the point where I'm going to have to make some decisions on what I'm doing with that portfolio. Hopefully there's not another crash or another big correction, because if so, I'm going to be royally screwed. But if there is, you know what? You just got to roll with the punches. That's kind of investing, and that's the risks you take when you're trying to do this thing on your own. Anyways, that's all I've got for you today. You know, if you enjoyed this video, please just subscribe, drop a comment if you have any questions, and give me a thumbs up if you liked it. All right, that's all I got for you. I hope to see you in the next video.